right, hello, and thank you all for joining us today for our webinar with Becker's. I'm Sophie Kellner from Professional Transition Strategies, and with me are Kyle Francis and Stanton Kensinger. And today we're going to be talking about capitalizing on consolidation, why dental entrepreneurs need to act now. So this is going to be very much mergers and acquisition focused for dental practice owners as they navigate this industry's consolidation wave. So before we dive in, I'd love to hand it over to each of you. We'll start with Kyle and then go over to Stanton. Please introduce yourself and a little bit about your background and expertise in this space.
Sure. Thanks, Sophie. So Kyle Francis, I'm the founder of PTS. Maybe to give you a little bit of background on myself, very much thought I was going to get involved in institutional capital. And back out of college, I had an offer on my table from Goldman to go and work for them in their investment banking division up in Dallas. Whenever you see the way they live life, it just kind of wasn't quite what I wanted, So, 100-hour work weeks, 200 days a year on the road, wasn't quite my style. And so I decided that I was going to go in through a back door, which is going to be by specializing in an industry. Took a couple hundred interviews out of college, found this funny little world of dentistry. All these entrepreneurs out there, some of them knew what they were doing and some of them didn't. And I was like, well, shoot, I can help them if nothing else. And so I had to learn it first, right? So I went on board with Sullivan Shine at that point, now Henry Shine, and started building offices out in West Texas. Did 30 or 40 ground up constructions out in that area. And I've got a baby face. People weren't taking me very seriously. So I started to do contract work. So I was doing lease renegotiations, buy-sell agreements, associateship placements, really anything I could get my hands on that people would take me seriously. And I just kind of horse traded. So I would do an associateship placement for a doctor, and then they would buy a new cone beam from me, that kind of stuff. By 2007, I was getting more calls for that than anything else. So I started up a company to specialize in transitions and transactions in the dental space. In the interim, I guess I was a practice owner, so I've owned 25 practices myself. I think that I'm much better as an M&A person or as a deal maker than I am an operator, though. And so I think 2017 started to scale the company beyond myself. And it's been a wild ride. It's been kind of riding the consolidation wave of dentistry. Had no idea that was coming. I would love to say I was prescient in that way. I was not. But 550 transactions in, and it's really, really interesting to see the way that this space has evolved over time.
Wow, that's really good, Kyle. Stanton Kensinger, PTS, the lead broker at PTS. I'm one of the rarities in this space where my background is not dentistry. I came into this world really with a background in commercial real estate, where I worked as a leasing agent, a buy-sell rep, and then I owned my own property types throughout time. So I've seen the ebbs and flows of markets. I've seen the highs. I've seen the lows. I've been through, my family's background is in commercial real estate, so I got to see recessions. I got to see boom times, and got to see some pretty cool things happen throughout. And then, oddly enough, became friends with this guy, Kyle Francis. It's a kind of a long story how we got there, but I started doing dental kind of transitions when it came to the real estate component. So I would help the broker renegotiate their lease at their existing practice, look to other locations to see if there was another option out there, as well as buying and or selling the asset. And as things kind of came along, the M&A world kind of jumped on us, and I needed to get to a point where I started the M&A side. So I've been here at PTS for 8 years and loving every second of it.
Excellent. Thank you both for that. I think that really helps set a lot of the groundwork for what we're going to be talking about today. So moving on to what we'll be discussing during this webinar, we're going to start things off by understanding why the industry is consolidating now and where we currently sit on that consolidation wave. And a lot of that has to do with private equity. It's shaken up the dental industry, and we really want to break down what that means for doctors just like you who are watching this webinar. And then finally, what we're realizing now is that time is of the essence. And so doctors need to understand a wide variety of factors that are currently at play and the reasons why they should probably start acting now when they're thinking about their dental practice transition. So as we kick things off, I'd love to hand it over to you gentlemen and just explain to us how far along we are on the consolidation wave.
Well, it's really funny, real quick. Kyle and I talked about it last week, and Kyle asked me, Stan, where do you think we're at? And I said, man, the market feels like we're anywhere between 28 to 32%. And so in going in through this, it was crazy to see that we're at 35%. But Kyle, I figured, why don't you go ahead and jump in?
Yeah, well,
It still blows my mind.
No, I know. And, every year we end up, looking at, the different white papers that are applicable and all those kind of things and just kind of determining what we think is going to be the most, because it's really hard to figure out how much an industry has consolidated, because it all depends on what you're trying to consolidate to, right? So is it going to be everything has to roll up to a single company to be consolidated? Or does everything have to roll up to a top 10 companies? Or does everything have to roll up to, call it a top 100 or 150 companies? Or do they need to be private equity backed, et cetera? I think that the most accurate way of looking at it is going to be, how much institutional capital is involved in these different transactions. And so if you look at it, with 375 plus DSOs that are out there that are going to be backed by institutional capital, and the amount of practices that they represent in comparison to the total amount of practices, I think 35% is the right way of looking at it in total. But if we look at, the big fish eating the little fish, right? So if you look at, Heartland's acquisitions of the, of the brands up in Canada, as a for instance, or of ADP, right? Those are going to be already what we would call consolidated, and they're consolidating even further. And that's going to happen too, right? So big fish are going to continue to eat little fish. But if I can encourage you with this, as we start to think about it, this is not unique to dentistry. This is something that every single industry goes through. And so there's these ideas of consolidation curves in total. That's something that we talk about a fair amount, Stanton, with our clients, don't you think?
Almost every time.
Yep. So whenever we talk about consolidation curves, the idea that we try to get across is going to be that, whether it was going to be medicine back in the 1980s, right? Or if it's going to be retail concepts, or if it's going to be, other sectors of medicine, those are going to be like our best comps in total.
Yeah, hospital systems.
Yeah, completely.
Crazy.
Yeah. So, but private equity is involved in all of these things, right? And so, if you look at where we are from a consolidation curve standpoint, I think we're closing in, if not there, on the apex of the consolidation curve. Now, that doesn't mean that suddenly it's going to drop off a cliff. Curves don't have cliffs, right? But I do think that means that we're more than halfway through at this point. And if that's the case, then that kind of informs decisions going forward as well.
Yeah, got it. And you said right now we're currently at the apex, but what I'm seeing is 35% consolidation. So what does that end number look like for folks?
Based off of what I've seen within the other sectors and the market research we've done, I would say anywhere between 60 to 70% is where we're going to really see that leveling off and or the end of consolidation. Not that consolidation is going to continue, but yeah, I would say that 60, 70%, and then long live private practice as long as it can to keep it going. But unfortunately, I think that's going to be our threshold. Do you agree, Kyle?
Yeah, I do. So, again, if let's think back over time. I remember growing up and having all these mom and pop hardware stores, right? Those kind of things. And if you look at the consolidation wave within the hardware industry, this is kind of primarily back in the 1990s. You looked at like Builders Square and Home Depot and Lowe's coming up, all those different places. And you also looked at consolidators like Ace, as a for instance, right? And Ace ended up kind of taking a whole bunch of mom and pop hardware stores to a singular platform. Now, here's the thing. That doesn't mean there's not mom and pop hardware stores. Those still exist. I was at one this weekend, right? And looking for a brand new wheelbarrow for my property. And so if I'm looking at that, that means that you don't go to 100% from a consolidation standpoint. Yeah, and I think that Stanton's right that the most viable research that we have says that it probably caps out somewhere in the 60 to 70% range. I remember meeting with a guy from the medical world, And he was saying that they track this over the course of time from a consolidation standpoint. They just kind of hover right around that 70% range. Sometimes it kind of drops off a little bit where people are kind of exiting hospital environments, and sometimes it kind of peaks up a little bit, but it just kind of hovers around that area. And there's a lot of really interesting reasons that occurs, but long story short, I think that's kind of where we're going. And I think that there's a lot of comps that get us there.
Yeah, I'll add primary care as another one that got sucked up by the hospital systems. I know urology, I know, is another big market. We got vision, ophthalmology, physical therapy, OBGYN. I mean, if you think about it, I mean, when you go to see any of those specialists and it's not within a hospital system or an already consolidated asset.
Yeah. And I know we talked a little bit about private equity, institutional capital. I'm curious, when did those folks show up, and what about dentistry is so attractive to them?
Well, I think one of our most interesting jobs in total is going to be, teaching private equity funds how to invest within dentistry and kind of the reasons why. But whenever we end up talking with folks who have had different investments within the dental fields or in multi-site medicine, the reasons that they're so interested is going to be that dentistry kind of works like a hedge against the rest of their risky assets. And so if you think about the way that a private equity fund is founded and kind of the way that it's developed in total, what they end up doing is they say, hey, we're going to invest in a very few amount of businesses, somewhere between, call it 5 and 10, for a smaller fund. And out of those 5 or 10, we want to have some risky assets, we want to have some really stable assets, and we want to have some very, very risk-averse assets. Dentistry is going to be a really risk-averse asset that happens to have the ability to provide very nice returns. One of the examples that we typically give as we're talking with these funds are going to be, a dentist's job primarily is going to be to make sure that their patients brush their teeth and floss. If they do that, their patients aren't going to have very many problems, and it doesn't cost very much either. However, if they don't, they're going to get cavities. If they don't get the cavities filled, they're going to need a crown. If they don't get the crown done, they're going to end up needing endo because it's going to start to hurt. If they don't have the endo done, they're going to have to pull the tooth because it hurts so bad. Now, how many of those patients are going to pull out their own tooth with their own set of pliers? Not too many. And the reason for that, from a, how much revenue comes in the door, each thing costs more than the previous, because if you ever want function back in your mouth, you can't just have no teeth. Right? You have to put something back in, and that costs a lot for the patient. And so it's a really, really risk-averse asset because of this recurring amount of revenue that comes in from hygiene appointments and then from all of these folks that don't necessarily take very good care of their mouths. So, overall, if you think about private equity, they very much like the idea that one of their most risk-averse type of assets has this type of recurring revenue. And then also, if you join them together, they can get a much higher multiple than they originally bought all those assets at. Do you talk about it differently to your clients, Stanton?
I try to simplify it just a little bit in that, think of your car and the car maintenance that is required to keep it running and operating. Because if you don't operate it and you keep it sitting in your garage, you're going to have deferred maintenance on your motor. You're going to have, depending on if you drive a lot, you're going to have tire issues. You're going to need to get them changed. You're going to have to get them fixed. Like, you can't have deferred maintenance, otherwise it's just not going to work. And if you keep it going, guess what? The car is going to run forever. It's the same thing with dental and everything in your mouth. As long as you keep rocking and seeing whoever you can, and keep the deferred maintenance from becoming a bigger issue, then you're going to be in pretty good shape.
Yeah, that's super fascinating. So it sounds like oftentimes the dental practice itself is a very smart bet for these private equity investors. But I'm curious, because we're seeing more and more DSOs crop up. What makes a DSO more investable to private equity than a single practice?
Well, I mean, I think a fair amount of this comes down to how private equity groups invest in total. And so, let's say that you're a fund and you have $100 million to invest, and let's say that you end up thinking through 4 or 5 different places you want to put your money. You might have some sort of technology style investment. You might have a retail style investment. You might have an investment in hotels and manufacturing. And then you end up saying, hey, you know what? I'd really like something in multi-site medicine, as a for instance. You kind of have two choices. Choice number one is that you end up going and buying a singular practice and then going out and buying a whole bunch of other singular practices and building the entire infrastructure from the ground up. But that takes forever, right? It takes so long to put those things together. And so instead, what most groups look for is going to be a jump start on their investment. And that's going to be going out and purchasing a group of practices to start out with, where they can start just adding additional practices, and that infrastructure is already built primarily. So, and then essentially what they're going to be looking for is going to be more capital in order to jumpstart that entire engine that had already previously been built. Now, here's the thing. There's not very many of those groups. I know we said 375, but in total, that's not a ton that end up coming to market all the time. And so what that essentially means is that the price of those go up because the total amount of them are not very many. So it's essentially supply and demand, right? So if the supply is down, demand is high, price goes up, right? Mm-hmm. And so because there's not very many of them, they end up demanding a much higher price than otherwise. And then it's the private equity group's job, or the DSO's job, to go through and purchase additional practices at a lower amount than they were just purchased for. And that cost averages their position down. And so that way, whenever they go back out to market, they have something that they can resell at a much higher amount than they cost average bought everything for. Did I answer your question, Sophie?
Yeah, I think so. Stanton, anything that you'd like to add to that one? I know we got really granular there, but I'm just curious.
Yeah, totally. I mean, they are an educated investor, right? So they have the ability to come in and look at a business and just make it more efficient, right? Because they can look at other sectors and other verticals and implement it within dentistry. And if you look at how segmented dentistry as a whole, I mean, you have these dentists that probably got out of dental school and didn't know what a P&L was, or a balance sheet, or anything that came. So the DSO and or the private equity says, okay, well, what if we bring them together? Let's try to make these just a little more efficient and improve margins by percentage points. And so with buying power in the marketplace, with marketing, bookkeeping, human resources, everything that they're able to bring in is just going to make it that much more efficient. If you can prove out same sales store growth, it's only going to make it that much more valuable, to Kyle's point.
Yeah. And I think what's really interesting in what you just said there, Stan, is like, we're starting to talk a little bit more about the benefits for the doctors. What we've talked about now, that sounds great. PE, they're really doing a good job and they're making smart investments. But how is that any different or any better for the doctors who are selling to these PE-backed DSOs? Because there's definitely a lot of lingering reputation that still exists of like corporate dentistry of the past and the DSOs of the past. So how is that changing, and how is that benefiting these doctors today?
How I think it's benefited is all of a sudden we now have optionality, right? Where before it was kind of one box fits all, right? It was 100% buyout. You work back for a few years, and again, it was a way to make it was a way to exit and a way to get a nice pile of cash, and that worked out for a lot of folks. And I think today, what has made our job so much, just exciting with what we're able to do, is depending on what the doctor's outlook is and or what is their exit strategy, we now have the ability to come and plug and play depending on what they're looking for. You know, are they looking to exit in a year? Are they looking to exit in 3 years? Are they willing to, do they want to exit in 15 years? We now have the ability to have options that just weren't available to us. And private equity has, again, being educated investors, has came in and taken from other sectors on what has worked and what hasn't worked. And I think what, Kyle, you would agree that the traditional model just isn't, it's worked and it's continuing to work, but it's not really in vogue in today's marketplace. And it's really allowed us as a firm to really find that match that is going to work for our sellers, where we just didn't have the optionality we did, call it 4 years ago.
I agree. And if we bring it back to the idea of a curve, you know, the people who are early on in a curve like this, typically end up making mistakes. And I think that those mistakes that were made were going to be not giving the doctors enough autonomy, not just with the clinical decisions, but also with what they want their life to look like. And so, as the consolidation has continued on within dentistry, what it is allowed for are going to be additional types of deals that would have never been thought of earlier on. And so the early on transactions were primarily focused on baby boomers, right? And so if you think about it from an investment thesis standpoint, you say, hey, there's all of this, there's this aging population in the United States. And by the way, this happens in a lot of different industries as well. There's this aging population, and they're all going to need to exit stage left at some point. And so if you're looking at trying to figure out a way of making sure that, you know, a group of dentists can continue on with this aging population of dentists, essentially it makes sense to have a really large infrastructure behind them for recruiting and for all of these different types of things. So that way, each one of the individual practices don't fall off of a cliff, right? And so now what happened there is going to be, there was this balancing act, right? The balancing act is going to be, how many services do we provide? How robust are those services? And then how invasive are those services?
Yeah.
And the problem was they got really invasive, right? And it affected the doctor's ability to do clinical. It affected, you know, the way that they felt about doing their job, all of that kind of stuff. And so as additional contenders have come into the marketplace, what it's allowed for is going to be these different types of structures out there that, I guess, allow the doctors to kind of choose your own adventure, you know, and try to figure out a way that they can, you know, make sure that they get what they want out of the equity of their business, as well as what they want out of, you know, a partner going forward.
And I'll add that there's nothing wrong with that model, right? It's just another option that we have to present depending on what the doctor's needs and wants are.
Yeah, because like, what if the practice is really in a terrible spot, right? What if that doctor really never really wanted to be a practice owner, and they just thought that's what they had to do, you know? And if they're in that type of position, and they might just kind of be more cut out for a group style environment where everything is taken care of and they can just go in and do the work, those options exist, right? It just so happens that more of the folks that we end up working with are looking to do more things with their equity rather than just taking that exit. But yeah, it's a valuable option to take.
Yeah. So it sounds like there's this optionality that now exists, and like, can I call that competition? There's a lot more competitive marketplace. And because of that, there are some opportunities and deal structures that maybe folks might not have had before, like say 10 years ago. I'd love for you guys to talk a little bit about what some of those may look like for folks. And if you have any examples that you'd love to call out from transitions that you facilitated to really highlight some of these different deal structures, I think that'd be really helpful to the viewers.
No, I think we just hit on the 100% affiliation model. The joint venture and or the JV model really came in vogue probably about 8 years ago, probably longer than that actually, but it really kicked off about 8, 9 years ago. And what that has allowed is the doctor owners to continue to retain equity at the practice level, which I think for our more entrepreneurial doctors really gravitate towards, because it aligns not only the group, but also with that individual to grow that practice over a period of time. And what's really cool about the option of a JV is that when there is a recapitalization event, so private equity trading with the next private equity firm for the next bucket of cash to continue to buy practices, is that they're able to sell a portion of that joint venture equity at the practice level at a multiple that would not have been achieved on the front end of any transaction with any dentist to dentist and or dentist to 100% buyout model. So it's allowed another option where it builds alignment between the DSO and the doctor to grow the business and to use the economies of scale and to use everything in that background to achieve a multiple that they have control within their own four walls. Kyle, is there anything you want to add?
Yeah, well, just like anything, there's no black and white on these things,
totally.
right? So sometimes there's different parts of all of these different types of deals within a singular transaction. But you know, if we think about it from a continuum standpoint on a JV, the JV can be really, really good from an entrepreneurial standpoint. Shoot, I've known folks that have gone out and put together 7 practices by buying with essentially that private equity fund's money, and then they end up transacting all of those practices together, and they kind of have their own like little mini empire, and I've seen it where they transact and then they essentially roll some of their equity into other practices at the day of transaction, and so maybe they didn't take out any ability to make money in the interim because they're still getting those distributions, but now they have just like a larger ecosystem to pull from. On the flip side, you also hear the not so great stories, right? And just like anything in life, there is good and there is bad, and so there are good DSOs and there are not so good DSOs out there. And so there's different DSOs that say they're a joint venture, and then whenever you really look into it, it's like, well, we're not really partners, it's different types of equity, and maybe the amounts that they can transact are going to be capped, right? Maybe they can't transact all of their equity. Maybe there's good reasons they're not transacting all of that equity as well. And so essentially, whenever we think about these things, don't think about them necessarily as good and bad, but more that they have another tool in their tool belt that they can offer. And practice level equity can be a really attractive thing. If I look at it from my own, I guess, personal scenario, if there was this big aggregator of M&A firms and somebody wanted to buy my company as a for instance, I probably would be attracted to a JV style deal. I'm probably a little bit, I have a more entrepreneurial bent. And even if that equity doesn't live at Holdco where it can grow much faster, maybe it feels better to me to get those distributions going forward as well. And so, if we think about it just from our financial hat, there are pluses and minuses to these things, but also if we think about it from what you want out of life hat as well, I think that people make great decisions once you understand what those options are.
Yeah, the one thing that I do want to add on this point is getting those monthly distributions for that percentage that you do retain, because that is a nice additional income stream on top of the W-2 that you would be receiving. And if you have a younger family and you're trying to save up for college, you have 4 or 5 kids, but you want to continue to practice dentistry for 10, 15 years, it is a nice additional revenue stream compared to some of these other models that just don't offer that. And so,
well, yeah, and on the flip side, we end up seeing like we were just talking with this PE fund, this last week, that they said, well, we would never do a JV model. It's not efficient enough, right? And there's some parts to that statement that are correct. If you end up having your equity live kind of at a mutual fund of dental practices, so rather than having it live at your own practice, but instead of owning 100% of your own practice, you own 1% of 100 practices instead. Man, think about the amount of risk that you just took off of your plate, because now it is not nearly as dependent on how your practice does, and how it's dependent on how the group of practices does. Along with that, if that's where the debt lives, right, is going to be at the DSO level, you get the benefit of, having a mortgage on all of those practices as well. And so, is that a good place? Do you want me to give that example of the way the mortgage works? Is that a good thing? Okay.
You're like, we're reading my next question.
Yeah, I think that's perfect.
Let's chat through that a little bit further.
Okay. Well, so people often ask, why is it that you can get these types of returns within dentistry, which is, on average, a 4 to 5 times return over a 5-year time horizon, which is exceptional. And one of the ways that I kind of wrapped my head around it is going to be, let's say you wanted to go and buy a house, right? And it's $1 million house. That $1 million house, you have 2 choices. One choice is going to be you give that person, whoever owns it, $1 million, and now you own a house. You own it outright. That's great. Most people don't make that choice. Most people decide that they're going to put a mortgage on that house. And let's say that mortgage is $750,000, which means you're $250,000 out of pocket to purchase that house. Now, let's say you keep that house for 10 years and that house is now worth $2 million. Well, your option 1 is going to be you sell it and you get $2 million, right? And your essentially net of that is going to be $1 million. You invested $1 million and you netted $1 million, right? Whenever we think about that from a return standpoint, we look at that as a 2 times return. 2 times return on your invested capital, right? So you invested $1 million, you got $2 million back. The other side of the equation ends up being, okay, you put $250,000 down. Now you had to service that note, right? Maybe you service that note with another $250,000. So you've now invested $500,000 and the bank still has $500,000, right? Now you sell that house still and you end up netting $2 million, or you end up grossing $2 million. You have to pay back the bank, right? So that's $500,000. And now your delta there is going to be $1 million still. So your outcome is still the exact same, but the amount that you invested is way less. So you invested $500,000 for a $1.5 million outcome. So that's going to be a three times return on invested capital. So essentially, whenever you have the benefit of debt at that holding company, your returns can be greater because you don't have to invest as much to have that same type of return.
Totally tracking there. As somebody who's not math minded, this is incredibly helpful when you can bring
I
it
think we
down
should
to
just call him Professor Francis from here on out. Is probably what we need to do.
I can't wait.
All right. I know we've spent quite some time talking JV on this in terms of deal structures, but any other ones that you feel are imperative that we call out before we move on to some of the next sections that we wanted to chat about today?
I think an equity role is just as important as a JV to go over. It's probably more common of all the different structures that we see out there. And it's 100% buyout, and the groups allow you to roll a portion of the proceeds into their holding company. We typically see it between 20 to 40% is what we see. And that capital is going to grow, kind of what Kyle was just indicating. It's going to grow 80% year on year conservatively. And that outcome for those doctors is going to be fantastic. I mean, because you're betting on not just your singular practice, but you're betting on the entire ecosystem, kind of the tide raises all boats concept. And if that DSO is out buying like-minded practices, working on same store growth, building in the economy of scale, building everything you're going to have an amazing outcome. And it's pretty cool that models and the success that we have seen in the past, and the doctors' outcomes have been amazing.
I agree. And maybe just one last thing, if there's that term sub DSO, a sub DSO kind of has some feelings of a joint venture and has some feelings of a holdco investment. The reason that you might have something like that is going to be if there's a group of practices in a certain geographic region that might have maybe operate more together, and there's another region that operates more together as well. So you might not own at the holdco, and you might not own at your practice level, but what if you diversified some of your risk and you ended up owning at a sub DSO level? So again, there's pluses and minuses to all of these different types of scenarios, and I think that the best way of determining that is putting all of those different, options in front of you, and then helping you make the right choice. Right? I think that's the key there.
I think after each one of our practice tours that we do, or after LOIs are submitted, we try to pick and choose, or at least guess which one they're going to go with. And how many times are we right?
Often wrong, very often wrong. Yeah. Well, and also I think another interesting thing is going to be, it's pretty rare that the highest bid ends up winning as well, because there's lots of other things that go into it than just the money side,
I'd actually love for you to break that down a little bit more. We hear that oftentimes, but what are some of those contributing factors that may make folks take a deal that may have a different dollar amount on the dotted line?
Culture. It's got to be number one. And that's part of our process is we do intros with each one of the groups and each one of with our sellers, because in my opinion, the money's awesome. But if you're going to be marrying somebody and you're going to be working for 10 more years or 15 more years, well, you better figure out the right one that's going to work for you, because we don't want you to be miserable. You don't want to be miserable, because if you're miserable, guess what? Your staff's probably going to be miserable, which is going to lead to a miserable patient care experience. And so that is so important to figure out who you're going to be doing business with. Who are the decision makers? Are they going to give you full clinical autonomy? Are they going to come in and fire your staff? Are they going to allow you to purchase who you want to? Are they going to change the name on the door? All those things are just so important to know in going into something like this outside of the numbers and the ultimate outcomes that are presented.
I'm going to give Matt Zolfo credit for this. I was talking with him yesterday. He's one of the brokers on our team, and we had a very nice practice come to market. There was about $5 million in top line, about $1.2 million in EBITDA. Obviously, all the different groups were going to be interested in it. So we had to cull it down to the top ones. I think we ended up getting something like 60 interested parties. We culled it down to 8 LOIs. And he was interested generally in 3 different groups. There were 2 equity role groups, and then there was 1 joint venture group. The highest value deal was one of the top 3. And as he ended up looking at it, or as the doctor ended up looking at it, he said, you know what, this practice group is not as developed as the other ones. They only had, call it like 30 or 40 locations. And the founder, who, by the way, is very, very interesting. And, if I look at it, has a ton of charisma, all that kind of stuff. But he is older, right? And so there's one who's like, okay, well, how long is this person going to continue on, right? And so it's like, even though they had the highest value deal, they decided that it wasn't the right fit for them. They looked at the other equity role deal and they were going to rebrand the office. And he just had so many emotional ties, right? Where it's just like, no, that's just not the right thing. That's not what I want to do here. And so we ended up choosing a joint venture option, even though, by the way, it was not quite as lucrative as the other two. And the reason being is it just kind of felt better to him. And he had a better idea of, how his world was going to be looking into the future.
Nice. That's a very interesting story. So it sounds like it's this wonderful combination of like wealth building opportunities for these entrepreneurial doctors, and then also finding the right culture fit that's really going to help preserve their legacy in the long run. I'd love to key in a little bit more on something that we actually talked about a little bit earlier. We chatted about, where does your equity live? And I think that's a really interesting thing to break down a little bit further, because there's this concept of equity arbitrage. And for those who are uninitiated, such as myself, I'd love for you guys to break down like how that impacts a lot of the deal structures and returns folks see.
I'm going to let Professor Francis just go nuts on it.
Oh man, I hope that doesn't stick. Anyway, so if people were, we get this question all the time. It's like, how does this work? Like, how do these types of returns get generated in total? Part of it is what I just went over beforehand. You have the benefit of debt leverage, right? And so whenever you have that, your returns can go up because you're using a lower cost type of financial instrument for some of the purchase of those practices. So that's definitely part of this. Is what's called a leveraged buyout. Those leveraged buyouts are going to be an important concept within the M&A environment, and essentially helps drive these types of private equity returns. However, that's not the only part that does. If you look at the other things that can drive these returns, some of that is going to be the amount of or I guess the breadth of services that are offered. So if you think about it, if every single doctor right now in their own private practice, every single one of them has their own accountant, right? Every single one of them purchases supplies on their own. Every single person might have their own health insurance or may not be able to offer health insurance, all those different types of things. As you get bigger as an organization, you can do these things at scale, and that saves each one of the practices a certain amount of money going forward. So essentially those shared services, if you are able to do them well, then suddenly that can help drive, real percentage growth in terms of overall EBITDA margin. The next thing is going to be that, from the fact that this is not like a group of buildings. A group of buildings is a static asset. And whenever you buy that group of buildings, sure, the market may end up saying that this is now worth more into the future. However, it's not really a living, breathing organism. And what I mean there is going to be that each one of these practices does have the ability to grow. And so that means revenue growth. That means you could grow the facility. That means you could grow the type of dentistry that you end up doing within the practice, all those different types of things. And that is same-store sales growth. Same-store sales growth is a really important concept as you get further along in the consolidation curve, and drives returns as well. Because whenever that practice is bought at a certain multiple of EBITDA, if the practice's revenue grows, well, the margin should be growing as well because you're getting economies of scale. So that kind of puts everything on steroids, right? So not only are you buying them right, you're going to be growing them, and you're also going to be doing things at scale that you couldn't have done beforehand. All of those things help drive this growth.
Excellent. Stan, anything to add on that one?
That's Kyle's sweet spot. I'm not going to touch it.
Sounds great. Okay, so we've chatted about equity arbitrage. We've chatted about recapitalization events, deal structures. You know what I haven't heard is multiples. And we hear from doctors all the time gloating about some of these multiples that they receive when selling their practice. And I would love for you guys to chat a little bit further about what does the multiple actually mean in the grand scheme of things?
Sam, do you want to take it?
Yeah, we love multiples too. We love multiples. But at the end of the day, does it really indicate the true practice, the value of the practice at the end of the day? And the answer is, it really depends. It's all over the place. I would say, because everyone's going to come in and value the practice differently, whether they're adding on additional benefits, they're taking away benefits. Everybody's going to look at a P&L and they're going to say, well, we can use these things, we can't use these things. And so everybody's going to come in differently than everybody else. And so I think we probably have it in here, but enterprise value is the thing that we really need to focus on when we're looking at comparing and contrasting apples to apples versus apples to oranges.
Yeah, completely. So if I think about it from like an individual practice perspective, we often hear that, hey, this doctor got a 10 times multiple. Well, that sounds good, but it's a 10 times multiple of what, right? And so how much EBITDA did they give you credit for? Because there's all these types of adjustments that can be done to EBITDA, because EBITDA is a really squishy number. So, the actual true definition of EBITDA is earnings before interest, taxes, depreciation, and amortization. That has nothing to do with how much travel you're running through your practice, right? Or different types of tax strategies that your CPA may have you end up doing, right? And so if we look at what that EBITDA is, the key is going to be that there is a market for that EBITDA. And that market is going to revolve around a lot of different things, but like, attractiveness of the area, recruitability to the practice, the type of work that practice does, the type of specialty. Does that group have additional practices that are close by? There's all sorts of different things that affect this multiple and affect how valuable the EBITDA is to that specific group. And so just saying that, somebody got a 7 times multiple really doesn't tell very much of the story. It's a 7 times multiple of what? And then beyond that, okay, then how are you end up getting that money? Do they have you be the bank on it? So are there just tons and tons of earnouts where essentially you're just kind of paying, they're paying you in a note, Well, that's not incredibly valuable, So like, I remember early on in my career, whenever people were buying practices individual to individual, much more often, we would say to the seller, hey, it's always a better idea to involve a bank here because you don't want to be both a partner and a bank, right? But there's different groups out there that's a necessity for their overall model. Again, does that necessarily mean it's bad? No, but it's something else to consider, right? So structure definitely drives these types of returns as well.
I have a doctor. I love him to death. Beautiful practice, to multi location, took in the market, and he got top of the market. From a multiple standpoint, he had a solid, healthy EBITDA. He called me one day and said, Stanton, I believe my practice is worth 11x. And I said, well, that's great, doc. I love every second of that. But why and how do you believe that your practice is valued at 11x multiple? He said, well, I talked to my buddy who sold his multi-site practice, but it wasn't in dentistry. It was in a different sector where he got 11x, and he believed because he got 11x that he should get one as well. Oh. And it's just like, you got to understand, not only is EBITDA and multiples altering, but you also got to know your market and know where we're coming in at. And it's wonderful that your friend got that outcome, but at the end of the day, it's a different market and probably a different consolidation curve as well.
Yeah, the market will bear what it's going to bear, right?
Exactly.
So if you end up doing a really great market survey to run a really great process to make sure that everybody who should be aware of that particular practice or that particular asset is aware of it, the market will speak to what the value is there, right? And anyway, looking at other industries or other specialties or other geographies, all of these things have interplay on the type of outcome that you can get.
Excellent. Well, thank you both for breaking that down. I know we only have a few minutes left, but as we are looking toward the future, I know we said at the beginning of this conversation, we've got about 5 years left in this consolidation wave. So what does this limited runway mean for doctors? And maybe what are some of those implications?
I think that a couple of things. So one, nearly every single person that we end up talking to, we end up saying, you don't need to do this. So that's thing one. If your practice is sweet and you want to continue on, just helping out your specific practice and essentially kind of taking that annuity, which is going to be EBITDA, out of the practice on a year-to-year basis, you'll be fine. We have lots of folks that we know that do this. Stan, we were just talking about one right before this.
Yeah, fantastic practice. Multiple associates within it, and we've been working on and off. Like, he wants to build his own DSO, he just can't do it, right? And so he'd rather try to figure out how to take his associate, kind of plug and play, do a hub and spoke model where his practice is the singular, and he's able to plop on other and build the culture with the associate, put him into the other location. But we've been working with him for almost 6, maybe 7 years now, and he's still at one location.
Mm.
And he hasn't been able to get over that hurdle of how to do it. And part of the reason is because of consolidation, and DSOs are buying up the good practices that he would have loved to have purchased otherwise. He's just not competitive in the type of offer he's able to make. And it's been a struggle. It's been a struggle for him, but he's gonna be just fine. He's crushing it. So whether he does decide to do it in the future and not get the type of multiples and or outcomes that we could get him today, at the end of the day, he's going to be just fine. And he's a great clinician, runs a great practice, and just a really he's going to have a good outcome whichever direction he goes.
Yep. But so if that's your floor, right? So if that's the floor, the way that I end up looking at time is going to be that these practice groups can only grow so far as there's other practices to be able to pull in that are really, really good. And there needs to be a bunch of them in order to have a practice group grow to the arena where you can get these like 80% year-on-year returns. Eventually, there's just not going to be as many of those, right? So either the practice has decided that they don't want to be a part of it, right? So they're not going to be a part of the consolidation wave, or the practice is not going to be attractive in some way, shape, or form, whether that's going to be geography or payer mix or age of provider or the overall revenue from it, all those different types of things. And so at some point or another, we end up kind of coming to a place that the type of returns cannot be as great, which means the arbitrage that you can get on those returns are also not going to be as great. Now, at some point, that may be a really, really nice, dividend paying stock, as for instance, right? So if you end up owning instead of a really, really high growth organization, but a really, really steadily grown organization, that isn't necessarily a bad place to have your money either, but the amount of arbitrage that you can get is different. So the key is going to be how long does your equity live in that arbitrage environment where you can get those returns. So if you only have, call it 4 to 6 years remaining, then suddenly it makes more sense to consider a transaction earlier rather than later, assuming all else is equal, right? And so I do think that, my idea even 2 years ago was going to be that a reasonable person could decide to have a transaction, not have a transaction, and that could be a good place to think through that. However, my idea has changed, over this last year, which is going to be, man, if you want to have the possibility of having, multiple turns of private equity within your your future, you probably need to have it happen sooner rather than later because these groups only recapitalize every, call it like 3 to 5 years. Yeah. And so we may be coming up on a place where you only have one recapitalization event before you end up owning that dividend paying stock. So time becomes more of the essence as you get close to the top of the curve. And essentially that's kind of where we are now.
Yeah. I also want to add, it's not a scare tactic. It is not something that we're trying to come in and say, you got to do it. You got to do it. That's not the case. It's the reality of this is happening. This is a wave that's going to continue. And if you want to have the opportunity for multiple recaps, then something to look into rather than later.
Yeah. And when you say something to look into sooner rather than later, what do those next steps look like for these doctors?
You call PTS. We'll get you run through our process because we need to figure out where you are today so that you can make a better decision for you in the future. Again, we like to deal in a perfect world scenario. We love to deal in perfect worlds, but the reality is that doesn't exist. But if we can find an outcome that fits your exit strategy, that's what we're here to do. Purely educate you about what is available to you in this marketplace today.
Excellent.
Yeah, I think the key is beginning with the end in mind. And the way that you do that here is going to be understanding what you have, right? The exact same way as a realtor will tell you what the market will bear for your house. It's going to be understanding what your practice's value is. And the way that you end up doing that is by, actually testing the market. And that means going out, seeing what the different types of deals are for your practice and determining at that point does option A, B, or C end up working for you, or are you better off just keeping it, right? And that's one of the big things that we end up looking at is going to be, well, if you don't need to do it, that should be considered in total, right? And I was just talking with a group, this was probably about 2 months ago. We did a full prospectus for them, went through a process, saw the different types of deals that came in, and they ended up making the decision that they wanted to add on an additional 5 practices. They actually had the money for it. They weren't going to be debt encumbered, all those kind of things. And that they were going to be going back to market at the end of this year. They're well along the way with adding those practices. And I expect that we'll take it back out to market. And then we could sell something bigger as well. But what the reason that they made the decision they did is because they had all of the options at their disposal. And they made the best decision for them at that point. So I think the faster that you make that decision of which is best for you, the better, because you have the ability to arbitrage if you want to, or you have the ability to grow, or you have the ability to always say no, right? The harder ones are going to be, well, what if that doctor wants to be out in 6 months? I've got one option for you, and that's going to be an individual to individual deal, right? And that isn't necessarily the worst thing in the world. Maybe you would have chosen it otherwise, but wouldn't it have been better to understand your breadth of options rather than just being shoehorned into that singular one?
Well, thank you both so much for the time today. This was a very fascinating conversation, all about the ins and outs of what's going on in the dental industry's consolidation wave. What is the best way for folks to get a hold of you two?
I would say email is great, so if you can also go on our website. I think we have, the ability to chat on the website as well, professionaltransition.com. So, either my email address, kfrancis@ or Stanton's at Stanton@. I think that's the best way.
Excellent. Well, thank you all for tuning in, and I hope you have a great rest of your day.